You wake up to the alarm on your iPhone. You check your emails via Microsoft Outlook. You grab a coffee at Starbucks. Fill your car at an Exxon station on the way to work. And after work, you pick up that pair of Nikes you have always been wanting to buy. To you, these are five different industries, five different companies with different CEOs, and five different battles for your loyalty and consumer dollar in a competitive free market. But if you pull back the curtain, have a deeper look and peer into the shareholder registry of these companies, the list of who actually owns these enterprises, you may be surprised that the names stop being different. Instead, they become a repetitive loop. The top shareholder for Apple? It is Vanguard. For Starbucks? It is BlackRock. For Nike? Vanguard again. Exxon and Microsoft? Vanguard and State Street. In fact, in nearly every major company boardroom on the planet, or the S&P 500 firms, the seats at the head of the table are already taken. They belong to the so-called Big Three, BlackRock, Vanguard, and State Street. Together, they manage about 30 trillion US dollars of assets. To put that in perspective, the GDP of the United States is around 31 US trillion dollars in 2025. The combined asset size managed by the Big Three is around the size of the entire US economy. But here is the mystery. This was not a corporate coup. It was not a conspiracy. In fact, they did not take this power. We gave it to them perhaps entirely by accident. You may ask, how and why did this happen? Let me explain. It actually started with a very simple, very honest desire. We wanted a fair and efficient way for our investments. Decades ago, if you wanted to invest, you had to pick individual stocks. It was like trying to find a needle in 1,000 haystacks. Most people failed in beating the market. Then came a revolution in logic and approach, which led to the birth of the index fund. In 1976, John Bogle, founder of the Vanguard Group, pioneered and launched the first retail index fund, pitching a radical idea. Instead of paying high fees to star fund managers who often fail to beat the market, investors should simply buy every company in the index at the lowest possible cost. The idea was brilliant in its simplicity. Don't try to find the needle. Just buy the whole haystack. By owning a tiny slice of every company in the S&P 500, you were guaranteed to grow as the economy grew. This is known as passive investing. It's the primary way millions of us save for our retirement today, holding exchange-traded funds, ETFs, and indexed funds. But here is the technical side effect. When we all buy the market through the same three providers, these providers effectively become the universal shareholders, and in turn they will be given allocated seats at the company's boardrooms. In the old days, Coke and Pepsi competed and fought for your loyalty. But today, if the Big Three own nearly 20% of both firms, they aren't rooting for a winner. They are rooting for an industry stability. This is what economists call horizontal ownership. It creates a world where companies act less like rivals and more like departments of the same global firm. See the drift? And there is more. Owning the world is only half the story. The Big Three will also have to manage the risk of managing the massive amount of monies. That is a task far beyond human capability. Enter Aladdin. BlackRock's proprietary application and risk management system. Aladdin speaks the language of investment portfolios, fully integrating the entire ecosystem with innovative cutting-edge technologies. It looks at everything, from geopolitical shifts, correlations to volatility patterns in the trillions of daily trades around the world daily. Because of Aladdin's prowess as the industry standard for portfolio and risk management, most of the investors in the world, including banks, pension funds, insurance giants, and even governments, now pay to use this same system to monitor their own portfolio risks. But here is the criticism. Regulators, including the UK's Financial Conduct Authority and the US Financial Stability Oversight Council, have expressed concern that the concentration of risk management on one platform creates a single point of failure. If Aladdin fails or provides flawed correlated risk signals, it could trigger widespread market instability. Although there has not been any of such incident, it nonetheless raises doubts of whether it is desirable for the market to have such a dominant force with the Aladdin system. Next, governance and proxy voting. The big three are, in fact, fiduciaries. That is a legal term which means they have a duty of loyalty to us, the people who put our savings into their funds. The big three don't just hold the shares, they have the power to vote at the boardrooms with these shares. They decide which social policies a company adopts, which CEOs get a bonus, and which industries get prioritized for the next decades and beyond. Ironically, while we didn't vote for the big three, the big three are voting for us with our shares and money. They have become the stewards of a system we built in our pursuit for the stability when we invested in their funds. Think about it. When three firms hold the collective voting power of the global economy, they can essentially become a private regulator themselves, regulating or controlling in a manner they so choose. Although there are reports and initiatives from the Big Three to provide ability for individual investors to cast their votes and voice their opinions, the reality is that as a minority shareholder, how many will really do so? That said, although it is easy to look at the numbers and see a giant monopoly, but the reality is a paradox. We are living in a managed ecosystem. We sought safety for our investments, and we found it. But as we look forward, perhaps we may want to ask, can a market truly reflect the wisdom of the crowd if the crowd has delegated its voice to just three powerful entities? If the primary goal of capital becomes the maintenance of the status quo, where will the next great disruption come from? Let me know your thoughts in the comments below. For more of the hidden stories and forces in global finance, subscribe to Secret Capital